I keep about 15% of my money in something that's barely grown in years. On paper, the worst performing thing I own. And if the market crashed tomorrow, it's the one part of my portfolio I would not touch. Everyone obsesses over which stock, which fund, how much equity. Almost nobody talks about this. And here's the part that still surprises me. The amount of this I hold today is exact opposite of what every textbook told me I should. By the end of this video, you'll understand why it might be the most important 15% I actually own. 3 things I want to walk you through. Why debt allocation matters, even though I'll prove this with actual numbers, it makes less money over 15 years. How much debt you actually need at each age, and why the textbook answer nearly cost me half my portfolio. And then I'm going to open up my own holdings and show you where I keep my debt, including one place I've actually put real money that I want you to be genuinely careful with. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firms before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. Let me start with the part that's uncomfortable to admit, because if I'm going to spend an entire video standing up for debt, I should be honest that on paper, it looks like a terrible idea. Let's look at this example. 2 investors, both putting 20,000 rupees a month into SIP, both for 15 years from April 2008 to April 2023. The first one goes all in on equity, everything into the market. The second one runs 70-30, 70 in equity and 30 in debt. And once a year in April, they rebalance it back to the same ratio. Same money in 36 lakhs each year. Now, the all equity guy ends up with about 97 lakhs and the 70-31 about 93 lakhs, which is about 4 lakhs behind. And it's not just about one split. The 80-20 lands at around say 92 lakhs, so it's about 5 lakhs behind. The 60-40, the most cautious one, comes in about 7 lakhs lower. So every single time you add debt, your final number drops, which makes you wonder, if debt is costing you money, why does literally every advisor alive tells you to hold it? Here's the thing, debt was never in the race for returns. It does a totally different job. And you only ever see that job on the worst days of your investing life. Let's back to early 2020, COVID. The Nifty went from 12,000 to around 8,000 in a matter of few days. A third of the market just gone. Almost overnight. On the 2nd of January that year, the all equity portfolio was sitting nearly at 60 lakhs. By the 2nd of April, 3 months later, it had dropped more than 33% down to about 40 lakhs. 20 lakhs wiped out in 3 months. Now, the 70-30 portfolio across those exact same days fell only about 22%. From around 57 lakhs to around 44.5. That little slice of debt actually reduced your loss to 12.5 lakhs. 80-20 fell about 5 lakhs less than all equity, and 60-40 held the damage to around 10 lakhs less. And before you think I just picked the one day that flatters my point, I didn't. Take the 10 worst crashes across the whole 15 years. The 70-30 portfolio fell less in every single one of them, not most, all 10. And on each and every occasion, that debt cushion saves you a lot of money. That's not luck, that shows up every bad day the market ever handed you. So that's what debt is actually buying. Not a bigger number at the end, a gentler fall when everything's coming down. Now to explain debt, this I feel is the best way to explain. In a car, equity is the engine. It's what makes you quick. Debt is a suspension. It doesn't add a single kilometer to your speed. What it does, it lets you go fast over a broken road without the whole thing shaking apart. When the road's smooth, that is in a bull market, the suspension feels like a waste. You forget it's even fitted. But the road always breaks eventually. And on that day, that quiet, boring bit is the only reason you're still on the road at all. See, debt is that friend you ignore when things are going great, and the one you wish you did listen to the second it all turns. If that made you rethink your own portfolio a little, hit the like button and subscribe. That's genuinely the only signal I get that this is actually useful to you and motivates me to make more of it. So if debt is so important, where do I keep mine? And before I get into that, I owe you some honesty. This video is sponsored by Wind Wealth, but you're getting my real opinion here, including the bits they would probably prefer I left out. But honestly, I don't know how to do it any other way. My debt sits in two buckets. The base of it is my EPF, the provident fund from my corporate years. Government backed, tax friendly, and the fact that I can't easily withdraw it out is honestly the whole point. That's the money I can't panic sell. That's a bedrock. And rest of my debt is in the debt mutual funds and bonds. And for the corporate bond investment, I've used Wind Wealth myself. So let me tell you plainly what it is. Wind Wealth is a SEBI registered broker and an online bond platform provider that enables retail investors to access corporate bonds. Corporate bonds is an investment avenue that was traditionally less accessible to individual investors but is now available to retail investors as well due to changes in SEBI regulations. The bonds listed on the platform can include senior secured bonds, where investors may have a claim on the underlying collateral and may have a priority in repayment over unsecured lenders, subject to applicable terms and legal processes. These bonds may offer fixed coupon rates, and depending on the issuer and the bond structure, fixed returns can typically range between 9 to 12% per annum, with tenures ranging from a few months to up to 3 years. You can start investing with amounts as low as 1000 rupees, and Wind Wealth also provides a dashboard to track your investments. So here's the part most sponsored videos quietly skip. If I'm pointing you somewhere, you deserve to know what can actually bite you. First, credit risk. These bonds are issued by companies including NBFCs, and there's always a chance that the company may delay payment or even actually fail to repay, which can actually impact your investment. However, I've noticed there are many bonds on the platform that are amortized, which means a part of your invested amount is paid back to you at regular intervals depending on the bond structure. This helps reduce the amount of money exposed over time, but it does not remove the risk completely. Second, liquidity risk. Wind Wealth provides a feature to sell your bonds before maturity. However, whether you can actually sell and the price you can receive depends on whether there are buyers available and the demand for the bond at that time. Selling early may affect your returns, and it can even result in a loss. Third, regulatory risk. There is no insurance or protection wrapped around this like the DICGC insurance or something similar. See, in other words, what I'm trying to say here is that this doesn't fall under the fully safe investment, but there are ways and means to de-risk. So you keep the tenure short and you spread your money across several bonds instead of one. That's how you manage it, which is precisely what I did as well. So who is it actually for? Someone who would need that money back in a hurry, who's putting a small slice in for diversification, who fully gets that they are taking a higher risk to earn more interest. Everyone else give it a miss because it doesn't fit what you need. My verdict? I keep it to a capped slice of my fixed income. The core of my debt stays with EPF and debt funds. Corporate bonds are the satellite, never the center. If you do want to try the platform, the link is in the description. That's debt handled carefully. Now, how much of it you actually even need? Almost all of it comes down to your age, and this is where I have to tell you about the mistake I nearly made. Every textbook, every formula, every calculator told me the same thing as I got older. Cut your equity, pile on safety. Get more conservative every year. I came very close to doing exactly that. And if I had, my portfolio today would be roughly half the size it is. I'll show you why in a second, but first, let me take you through the decades. Watch one number climb as we go, your debt floor. The least amount of cushion you should carry at each stage of your life. I'll actually call out the balanced version out loud. You can actually see the aggressive and the conservative ones on the screen. You can take a screenshot if need be. Pick the one which actually suits your requirement. 20s, the one decade where debt barely matters. You've got the longest runway you'll ever have, so a 40% crash is just a sale you get to buy into more. Moderate is roughly 90-10. In 30s, now debt earns its keep because life shows up. A loan, a family, real things resting on your income. Floor rises to about 85-15, still mostly equity. But now the debt's a choice, not an accident. Now 40s are peak earning years, but the big bills are close. School fees, those EMIs of home loans, floor climbs up to around 75-25. And this is where my own story breaks the rule. The formula said cut the equity. I did the exact opposite. My income got steadier. I understood equity far better, so I took more risk, not less. That single decision is the difference between my portfolio today and one half its size. So treat these numbers as a starting line, not a sentence. Now in your 50s, retirement's about 10-15 years away, and a crash now is one you might not have time to recover from. The cushion turns structural, moderate around 70-30. Here's why. In any single year, the odds of a -1 are about 1 in 3. You can actually shrug that off at 25, but you can't afford it the year before you stop working. Once you hit your 60s and go beyond, it's actually a flip. Debt goes from passenger seat to driver seat because now you're pulling money out, not putting it in. The moderate rule will be near 60-40, sliding further as you pass 70. And there's a hard reason. In retirement, you live on the 4% rule, and in India, I strongly suggest it to be 3.5% or less. If a crash forces you to sell equity at the bottom just to eat, that loss is permanent. Debt is what saves you from ever being in that position. Now, you must have also heard of the famous shortcut for this, 100 minus your age rule. That's your equity. It's again a fine place to begin with, but don't read it like a scripture because it's blind to everything that matters. Let's look at two 30-year rules. One's got a shaky job, no safety net, real debts. The other's got a rock solid job and barely any liabilities. The formula tells both of them 73% equity. You can see for yourself those two people don't have remotely the same relationship with risk. So forget the single number. Your real floor comes down to 6 things. Your age, when you actually need the cash, how stable your income really is, what you owe and who is dependent on you, the cushion you've already built, and the 6th, the one everybody underrates, your own psychology. Because if a 30% drop would have you selling in a panic, then on paper you can take the risk, but in real life you can't. Hold that thought because that's where the real damage gets done. And now I want to show you the single most backwards feeling thing in all investing. Because here's a number that should bother you. Remember how your pure equity portfolio fell 33% in the COVID crash? Most people looking at that do the worst possible thing at the worst possible time. And it's not stupidity, it's a trap built into how a portfolio grows. Now here's how it actually works. You set up a clean 70-30. The market runs, your equity nearly doubles, and suddenly equity is far bigger chunk than you ever signed up for. Meanwhile, your debt is still sitting there, not growing much, looking useless next to all that green. So the urge hits. Dump the debt, it's dead weight, let the winner run. And that is the exact moment you should do the opposite. Sell a bit of equity, top the debt, and get back to where you actually started, which is a 70-30 ratio. I know how mad that feels mid-bull run. Trimming your best thing to feed your worst thing, and it sounds like financial self-harm. But that one move quietly answers the question that tortures every investor alive. When do I book profits? And when do I actually buy more? You stop having to guess. Market runs hot, your 70-30 drifts to say 80-20, you sell a little equity into debt, here's your profit booked at top automatically. Market crashes, you drift to say 60-40, you move debt into equity. There's your buying cheap, right when everyone is actually frozen. I know I'm making it sound simple when it actually isn't. But what this helps with is the discipline you could never force on yourself. Your allocation just does it for you. One caveat, don't fiddle constantly. If it drifts more than 5 to 10% of target, gently nudge it back. That's all. Which leads me to the 3 mistakes that quietly destroys the debt side of a portfolio. First, sudden changes. The minute people learn all this, they want to fix everything by Friday, ripping money out of debt and into equity mid-bull run right before it tips over. Shifting your allocation is like steering a big ship. Turn it slow and steady. Do it otherwise and things can topple. Second, flying blind. You actually know your risk profile, but your money is invested nowhere near it. 4 usual reasons. You don't know enough, so everything sits in a savings account. You're lazy, so you set it up once and let it drift. Herd instinct, where your neighbor made a fortune in an equity, so you piled into, never asking if this situation actually looks anything like yours. And the rear view mirror trap, chasing whatever just did well. Gold jumped 25% last year, everyone floods in, and that one hurts debt most because debt almost never tops the chart. So people ditch the exact thing meant to protect them just because it's did its job quietly. Third, and this is the root of nearly all of them, emotion. Let me show you how this actually played out because we just lived through the cleanest example there's been ever. After the COVID crash, people lost all their faith in equity, sold their funds, dumped their shares, stopped their SIPs. Then the market did the thing nobody saw coming. It bounced back fast. And now those same people were terrified of the missing rebound. So they came charging back in. Except now fear turned into greed into overconfidence, and the money flooded in right near the top. Then the next correction came. And what did they do again? Fear again. Pulling money out at the bottom, locking the loss in for good. Sold low, bought high, sold low. The exact reverse of everything that builds wealth. That's why your allocation has to be set when you're calm on those 6 things and then guarded from your own feelings. So let me bring it all the way back to where we started. That 15% that's barely grown and the worst performing thing I own. Yes, my debt has made me less money. It's always will. That's not the point, and it never was. The reason I'll still protect that 15% before anything else is simple. It's the reason I'd never had to abandon my plan when everyone around me was panicking. It's the reason a crash has never once forced my hand. Equity is what builds your wealth, but debt is what makes sure you're still standing to enjoy it. So go back and look at your own split, not the stocks, the boring part. Because that boring part is that whole reason the exciting part ever gets to keep growing. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thank you for watching, and I'll see you in the next one.